Our old relationship of steadily deepening integration with the United States is over. The 80-year period when the United States embraced the mantle of global economic leadership, when it forged alliances rooted in trust and mutual respect, and championed the free and open exchange of goods and services.
$10,000 added to the price of a single vehicle. 500,000 American manufacturing jobs at risk. Energy prices climbing towards $7.50 per gallon in parts of the Midwest. And a projected $450 billion in lost tax revenue tied directly to auto sector disruption. This is not a theoretical exercise in economic modeling. It is the measurable fallout of a rapidly escalating trade war between the United States and Canada. Mexico, a policy shift that has fundamentally altered the structure of North American industry in less than 18 months. These numbers are only the visible damage. Beneath this trade war, a far more devastating structural rupture is unfolding, one that could permanently redraw the balance of economic power in North America. Today, I will reveal the full scale of the destruction, the hidden financial hemorrhaging, and the internal projections so severe they have never been publicly disclosed. What is emerging is not a temporary policy dispute, but a transformation so profound and so costly that it could redefine the future of the United States, Canada, and the entire continental economy. Within months of the tariff escalation in this expanding trade war, internal cost structures across the United States automotive sector began to fracture at a pace few executives anticipated. Industry analysts estimate that when a 25% tariff is applied repeatedly to components that cross the border multiple times between the United States and Canada, the cumulative burden can raise total production costs per vehicle by $8,000 to $12,000, depending on configuration. That increase is not absorbed quietly. It moves directly into the final sticker price. The average transaction price for a new vehicle in the United States had climbed above $60,000 in several major segments. Full-size pickup trucks, traditionally viewed as working-class staples, began approaching price points once reserved for luxury brands. At the same time, auto loan interest rates moved above 7% nationally, compounding affordability pressures for middle-income households. The result was immediate demand contraction. Dealer inventory began accumulating. New vehicle registrations in several major metropolitan regions fell by more than 50% compared to the previous year. Used vehicle prices surged in response, creating a secondary inflation spiral that pushed 5-year-old models to valuations rarely seen outside supply shock conditions. For manufacturers, the math became even more severe. Public financial filings from major United States automakers revealed rising input costs for Canadian aluminum, specialty steel, and precision electronics sourced through Mexico. Analysts warned that even a 10% sustained drop in sales volume could translate into tens of billions of dollars in lost annual revenue across the sector. Supplier networks, many of them small and medium-sized firms, located in Michigan, Ohio, and Pennsylvania, faced liquidity strain as order volumes declined. The broader macroeconomic impact extended beyond dealerships. Automotive manufacturing contributes significantly to tax revenue, pension fund stability, and regional employment across the industrial Midwest. When production slows, state budgets tighten. When consumer purchases stall, sales tax receipts fall. When stock valuations decline, retirement accounts absorb the shock. This is no longer a narrow policy debate about tariffs. It is a systemic stress test of how deeply integrated the United States and Canada have become under decades of continental trade agreements. But what makes this phase of the trade war even more destabilizing is not only the rising cost inside the United States, it is the strategic counter-movement unfolding quietly in Ottawa. There is a policy shift underway in Canada that has not yet been fully understood in Washington, and its implications could prove far more disruptive than the initial tariff shock itself. What began as a tariff escalation has now evolved into a structural fracture inside the North American economy. The trade war between the United States and Canada is no longer confined to automobiles. It has expanded into energy, critical minerals, agriculture, and sovereign capital flows, and the scale of disruption is accelerating. In 2026, The United States imports roughly 4 million barrels of crude oil per day from Canada. That represents more than half of total United States crude imports. When diplomatic tensions intensified under the expanding trade war, energy markets began pricing in supply risk almost immediately. Even a temporary reduction of 10% in Canadian crude flows pushed wholesale gasoline futures sharply higher in Midwest trading hubs. Regional retail fuel prices in parts of Illinois, Michigan, and Ohio approached $7 per gallon during peak volatility periods. Diesel costs surged, raising freight expenses nationwide. For every $1 increase in diesel prices, transportation economists estimate that shipping costs for consumer goods can rise between 5 and 10%. That translates directly into grocery inflation, construction cost inflation, and logistics pressure across supply chains. Energy is leverage, and Canada understands this. Beyond oil, Canada controls significant reserves of lithium, nickel, cobalt, and potash inputs critical to electric vehicle batteries, semiconductor manufacturing, and agricultural productivity. In an environment shaped by trade war tensions, even minor administrative delays or export review policies can tighten global supply. Markets do not wait for formal embargoes. They react to risk perception. At the same time, capital markets began reassessing long-term manufacturing exposure inside the United States. Foreign direct investment into Canadian clean energy and battery manufacturing facilities increased sharply in 2026 as multinational firms sought regulatory stability. Investment announcements in Ontario and Quebec signaled multi-billion-dollar commitments to battery cell plants and electric vehicle component facilities projects explicitly designed to serve global markets without being trapped inside tariff corridors. Inside the United States, manufacturing executives faced a different calculation. If production costs remain structurally elevated due to persistent trade war friction, long-term plant expansion decisions become uncertain. Automotive manufacturing supports approximately 1 million direct jobs and several million additional indirect jobs across logistics, steel production, software engineering, dealership networks, and maintenance services. Even a 15% contraction in production volume would reverberate through regional labor markets. The unemployment impact would not be evenly distributed. Industrial Midwest states, already sensitive to cyclical manufacturing swings, would experience concentrated strain. Local tax bases would weaken. Municipal bond markets could face pressure. Pension systems tied to manufacturing payroll contributions would see funding gaps widen. Meanwhile, financial markets monitor risk exposure closely. Automotive and industrial equities represent a substantial portion of retirement portfolios across the United States. A sustained earnings contraction of 20 to 30% in major manufacturers would directly affect household wealth, particularly for Americans over 40 who rely heavily on equity-linked retirement accounts. This is where the trade war begins, transforming from a policy instrument into a macroeconomic destabilizer. But perhaps the most consequential development is strategic alignment. Canada and Mexico continue operating under a bilateral framework that maintains fluid trade flows between them. If supply chains reorganize around a Canada-Mexico axis while the United States remains encircled by tariff barriers, continental production geography could gradually shift south and north, bypassing traditional United States hubs. Such a reconfiguration would not happen overnight. However, once capital investment is redirected, it rarely returns quickly. Infrastructure builds where policy risk is lowest. Skilled labor migrates toward growth corridors. Technology clusters follow predictable incentives. The most unsettling question emerging from this phase of the trade war is not whether prices are rising today. It is whether North America is quietly entering a structural realignment in which the United States risks becoming the high-cost outlier in its own regional market. And there is one additional layer of exposure that has received little public attention, a fiscal dimension tied to federal revenue and sovereign credit stability. That dimension has not yet been fully quantified in mainstream debate, and its implications could prove even more severe than rising gasoline or vehicle prices. The deeper this trade war progresses, the clearer one reality becomes: tariffs do not operate in isolation. They interact with fiscal policy, consumer demand, sovereign debt, and long-term competitiveness. And in 2026, the United States is beginning to feel pressure across all four fronts simultaneously. Start with tax revenue. Automotive manufacturing contributes tens of billions of dollars annually in federal and state tax receipts. Corporate taxes, payroll taxes, sales taxes, fuel taxes, the sector touches nearly every fiscal stream. If national vehicle sales decline by even 20% for a sustained period, federal analysts estimate that cumulative revenue losses over 3 years could approach $400 billion when secondary economic effects are included. That figure matters because the United States already operates under elevated debt servicing costs. With benchmark interest rates above 5% for much of the past year, federal borrowing expenses have climbed sharply. A reduction in tax inflows combined with higher debt service payments creates a widening fiscal gap. Credit rating agencies monitor this dynamic closely. While the United States maintains deep capital markets and reserve currency status, prolonged economic friction driven by trade war policies increases perceived policy volatility. Even a minor sovereign rating outlook revision can increase borrowing costs across treasury markets, corporate bonds, and municipal debt. The ripple effects would be immediate. Higher treasury yields translate into higher mortgage rates. Elevated mortgage rates slow housing demand. Slower housing markets dampen construction employment. Construction employment affects regional labor stability. The chain reaction extends well beyond auto factories. Meanwhile, competitiveness metrics reveal another layer of strain. Over the past 3 decades, North American manufacturing has operated as an integrated platform. Canadian raw materials, Mexican labor-intensive component assembly, and United States high-value engineering combined to create a cost-balanced ecosystem. The 25% tariff regime disrupts that architecture. If United States production costs remain structurally above global averages by 10 to 15%, export competitiveness declines. Vehicles assembled in the United States become less attractive in Latin America, Europe, and Asia. Market share erosion abroad compounds domestic demand weakness. At the same time, Canada has positioned itself as a stable supplier of critical minerals essential to electric vehicle battery chemistry. Lithium, nickel, and cobalt supply chains increasingly determine long-term auto industry viability. If battery manufacturing capacity expands more rapidly north of the border, long-term research and development ecosystems may cluster around those facilities. Once research clusters relocate, reversing that migration becomes difficult. Labor migration trends provide early signals. Skilled engineers, software developers, and advanced manufacturing technicians respond to opportunity density. If investment announcements increasingly favor Ontario or Quebec over Michigan or Ohio, talent flows follow capital. The United States would still retain enormous economic strength, scale, innovation, capacity, financial depth. But even modest relative shifts alter long-term trajectory. In global manufacturing competition, marginal advantages compound over decades. There is also the consumer inflation dimension. If automotive price inflation remains elevated at 8 to 10% year over year, while general inflation moderates more slowly than expected, consumer confidence may weaken. The University of Michigan Consumer Sentiment Index has historically shown sharp declines during periods of transportation cost spikes. Lower confidence reduces discretionary spending across retail sectors, further slowing growth. And then there is agriculture. Canada and Mexico represent 2 of the largest export destinations for United States agricultural products. In a prolonged trade war environment, even small retaliatory measures, regulatory reviews, phytosanitary inspections, quota adjustments can redirect purchasing toward Brazil or Australia. Farmers operate on narrow margins. A 10% export contraction can push many operations into loss territory. Bankruptcy rates in agricultural lending sectors tend to rise quickly when export markets contract. At this stage, the trade war between the United States and Canada is no longer a single industry story. It is an interconnected macroeconomic challenge touching energy, manufacturing, housing, agriculture, finance, and labor mobility. Yet despite mounting indicators, one crucial strategic question remains unresolved. Is this disruption a short-term negotiation tactic designed to extract structural concessions, or has North America already crossed into a semi-permanent phase of economic decoupling? The answer may determine not only vehicle prices, but the competitive position of the United States for the next generation. The longer this trade war continues between the United States and Canada, the more it evolves from a tariff dispute into a structural geopolitical realignment. What began as a 25% import measure has now influenced capital flows, currency stability, and long-term industrial geography across North America. Markets are no longer reacting only to price increases. They are recalculating risk exposure for the entire continent. One of the most under-examined developments is currency positioning. While the United States dollar remains the world's primary reserve currency, sustained policy volatility can influence global portfolio allocation. Even a small rebalancing of central bank reserves away from dollar-denominated assets can affect treasury demand, long-term yields, and sovereign financing costs. Canada, by contrast, has leaned heavily into resource-backed stability. Its leverage over energy exports and critical minerals has positioned it as a strategic supplier during a period of global electrification and supply chain security concerns. In a trade war environment, resource control becomes negotiating power. The electric vehicle transition amplifies this dynamic. Battery production depends on secure access to lithium, nickel, and cobalt, and Canada holds significant reserves of all three. If future battery manufacturing clusters continue expanding outside the United States due to tariff friction, research and development ecosystems may shift with them. Manufacturing relocation rarely announces itself in dramatic headlines. It occurs gradually through capital expenditure decisions, joint ventures, and regulatory approvals. Over 5 to 10 years, these decisions reshape regional economic influence. Financial markets are already pricing risk differentials. When investors perceive regulatory uncertainty in one jurisdiction and relative policy consistency in another, cost of capital diverges. Even a 1 percentage point difference in long-term borrowing costs can determine where the next generation of factories is built. Labor mobility is another early signal. Engineers, data scientists, and advanced manufacturing specialists tend to follow growth clusters. If sustained investment momentum builds in Canadian industrial corridors while uncertainty lingers in parts of the United States, talent migration could reinforce capital migration. The fiscal dimension compounds this risk. Lower corporate profitability inside the United States reduces tax revenue, while higher debt servicing costs increase federal obligations. If automotive contraction overlaps with broader economic softness, budget deficits widen further. Agricultural exporters are watching closely as well. Canada and Mexico remain two of the largest buyers of United States farm products. In an extended trade war, procurement diversification toward South America or Asia could compress American farm incomes for multiple planting cycles. At the geopolitical level, alliances matter. Canada has strengthened trade coordination with European and Indo-Pacific partners, reducing dependence on United States market access. If North American integration weakens, global competitors may capture the production capacity gap. None of this implies immediate collapse. The United States remains the largest economy in the world with unmatched financial depth and technological innovation. However, sustained friction with Canada inside a trade war framework introduces compounding disadvantages over time. The central question is no longer whether tariffs increase prices. That is already visible in showrooms and fuel pumps. The deeper issue is whether the United States can recalibrate without triggering a longer-term competitive erosion across manufacturing, energy, and technology. What remains undisclosed publicly is the internal scenario modeling being conducted by multinational corporations regarding a permanent restructuring of North American supply chains. If those contingency plans move from spreadsheets into groundbreaking ceremonies, the continental balance of power may shift more quickly than most policymakers anticipate. The current trade war between the United States and Canada is no longer operating at the level of tariffs alone. It is approaching a tipping point where compounding pressures, fiscal strain, industrial contraction, capital flight, and energy leverage begin reinforcing one another in a self-accelerating cycle. When multiple sectors weaken simultaneously, recovery becomes exponentially more difficult. Automotive output declines are now intersecting with higher borrowing costs and shrinking consumer demand. If vehicle production in the United States contracts by 25% over 2 consecutive years, the cascading effect could place more than 1 million direct and indirect jobs at risk across manufacturing, logistics, steel, and dealership networks. That scale of contraction would rival some of the most severe industrial downturns in modern American history. At the same time, consumer purchasing power is being eroded from multiple directions. A $10,000 increase in average vehicle prices does not exist in isolation. When fuel prices rise, freight costs rise. When freight costs rise, food prices rise. When food prices rise, wage pressure intensifies. This is how a trade war transforms into sustained inflationary momentum. The fiscal implications are equally severe. A projected $400 to $500 billion in reduced automotive-related tax revenue over 3 years would collide with rising federal interest payments that already exceed $1 trillion annually. If bond markets begin demanding higher yields to compensate for perceived policy volatility, debt servicing costs could escalate further, tightening federal budget flexibility. Energy remains the silent force multiplier in this conflict. Canada supplies more crude oil to the United States than any other nation. Even a sustained 15% reduction in exports would tighten refining capacity across the Midwest and Gulf Coast. Diesel shortages would directly affect trucking corridors that move 70% of American domestic freight by value. Agriculture could become the next pressure point. If retaliatory procurement shifts redirect even 15% of Canadian and Mexican agricultural imports away from the United States, farm income volatility could spike sharply. Bankruptcy filings in rural regions tend to increase rapidly when export markets narrow, and rural banking systems are particularly sensitive to commodity price swings. Financial markets would not remain insulated. Automotive equities, industrial suppliers, and regional banks tied to manufacturing exposure could see earnings contractions exceeding 30% under prolonged stress conditions. Pension funds and retirement accounts heavily weighted toward industrial and consumer discretionary stocks would absorb material losses. Currency dynamics introduce another layer of vulnerability. While the United States dollar retains global dominance, sustained trade war friction can reduce capital inflows at the margin. Even a modest shift in global reserve allocation away from dollar-denominated assets could elevate long-term treasury yields, raising borrowing costs for households and businesses. Meanwhile, Canada continues reinforcing supply chain alliances beyond the United States. Diversification agreements with European and Indo-Pacific partners reduce its exposure to American demand cycles. If continental production realigns around a Canada-Mexico axis with lower tariff friction, the United States risks becoming the high-cost manufacturing zone within its own region. This is how structural decline begins, not through a single catastrophic event, but through accumulated policy friction that gradually erodes competitiveness. Once factories close, reopening them requires years of capital, labor retraining, and regulatory clarity. Once talent migrates, attracting it back requires sustained growth momentum. The trade war has already delivered visible price increases and employment strain. What remains uncertain is whether policymakers can reverse course before the structural damage becomes embedded. If current trajectories persist, the United States could face a prolonged period of slower growth, elevated inflation, and diminished industrial leverage relative to Canada. The most critical variable now is time. Every quarter of sustained uncertainty increases the probability that multinational corporations will make irreversible relocation decisions. If those commitments solidify, North America may not simply be adjusting to a trade dispute. It may be entering a permanent reordering of economic influence. The trade war between the United States and Canada has now moved beyond headlines about tariffs and vehicle prices. It has become a defining economic stress test for the structure of North American integration. $10,000 added to the average car, energy volatility rippling through transportation networks, manufacturing employment exposed to prolonged contraction, Federal revenue projections under pressure. These are no longer speculative scenarios, they are measurable signals. The United States still retains immense structural advantages: scale, innovation capacity, financial depth, military strength, and the world's most liquid capital markets. But even large economies are not immune to compounding policy friction. When a trade war begins to reshape supply chains, redirect capital, alter energy flows, and influence currency positioning simultaneously, the cumulative effect can shift competitive balance over time. Canada has responded with strategic diversification, strengthening trade corridors beyond the United States and reinforcing its role as a supplier of energy and critical minerals. That does not mean Canada is immune from risk. However, it does suggest that in this phase of the trade war, Ottawa has positioned itself to absorb disruption while expanding global partnerships. For American workers and middle-class families, the issue is immediate and practical. Higher vehicle prices reduce mobility, higher fuel prices increase daily living costs, slower manufacturing growth affects regional job stability. Rising federal deficits limit long-term fiscal flexibility. These pressures converge at the household level. The central question now confronting policymakers in Washington is whether the current trajectory represents short-term leverage within a broader negotiation strategy or whether it risks embedding long-term structural disadvantage for the United States within its own continental market. Trade wars can be tools. They can also become traps. If supply chains permanently reorganize around lower friction corridors, if capital investment accelerates outside United States borders, and if energy leverage continues shifting northward, the economic landscape of North America could look fundamentally different within a decade. Is this a bold strategic recalibration for the United States or a costly gamble that may redefine continental leadership for a generation? Thanks for watching.